as soon as the clock hits 10:30, you can start talking. Use that microphone. Morning. Thank you.
Good morning, everyone. Before we started in the exciting topic of corporate finance, I just wanted to remind everyone to buy their tickets for TSDL. It's definitely more than just a sustainable fashion show. It is the social event of the semester, and it goes to a great cause of supporting a lot of our peers who are going to be doing nonprofit or social impact work this summer. It may not make as much as the rest of us, so this will help so that they can actually still afford to live around New York City. So please come out and support your peers and buy your tickets to TSDL. See you there Friday night.
Is this the one where faculty dress up and stuff as well? I have two problems. One is I never stay in the city after 5. Once the sun goes down, I turn into a vampire. So I've got to get back home. The other is, as you can see, fashion and me are very divergent paths. Actually, there have been 5 people this morning who've stopped me. They were hanging out on the stairs. They said, I have a question. I thought the question was going to be about the quiz. And the question was about my sweatshirt, because it's throwing people off, right? Because last week I was a Bruin, and all of a sudden I'm a Bear, right? And actually I have allegiances to both. I went to school at UCLA, but I started my teaching at Cal. So you say, and 5 years ago, actually, somebody in this class bought me an NYU sweatshirt. I can't get myself to wear it, I have to be quite honest. I don't like violet. The color freaks me out. So I made them a promise. When NYU gets to the Final Four, I'll wear the sweatshirt. Okay, if you have no idea what I'm talking about, you obviously don't follow college basketball, but that's what happens when you go to NYU. You don't even realize there's college basketball. Anyway, reminder again that your quiz is on Monday. 10:30 to 11, so please don't be late. And if you're not going to make the quiz, somebody remind me again what you have to do. Because if I say it, you forget it anyway, so I want somebody in the class. What are you supposed to do if you're not going to take the quiz? You have no idea. What? No, before that you got to do something else. You've got to let me know before the quiz that you're not taking the quiz. This might sound like nitpicking, but if I don't do that, and this is harsh experience, there are a few people, unscrupulous people, not people like you, people who obviously don't show up for class, unscrupulous people who actually show up for the quiz, take the quiz, and then take the option. You know what I mean by the option? Which is, I have no idea who's sitting in the room, so if you put your quiz in there and say, I didn't show up for the quiz, so I can't give you the option to take the quiz and then say, quiz didn't go well, so I'm going to act like I'm not. So if you're not going to take the quiz, just let me know before the quiz. And if you don't take the quiz, now tell me what happens. You take the other two, and, this is a 10% quiz. What happens to the 10%? It gets reallocated across your other exams. So your second quiz will become a 12% quiz, your third quiz will become a 12% quiz, and your final will become a 36% final. So you're not going to lose points, but you do lose that option of having your worst quiz be marked up to the average. So keep that in mind, because on Monday morning you wake up, you're feeling perfectly okay, but you feel this flu coming on. Or you dreamed about throwing up and you decided dreams are real. and you decide to take I will trust you. If you say, I'm feeling sick, I'm not going to ask you to give me a doctor's note. What is this, 6th grade? So I will trust you, but remember, you have given up your option. Right? So let's pick up where we left off. I will send you also the seating for the quiz, because as I said, 120 of you will end up in 260, and the rest of you will be here, so you have more room to spread out. Okay? And for the next 3 days, you'll be getting emails from Nigeria. So if your email account is set up to block all Nigerian emails, I'm going to find a way to get through to you, because I'll be in Nigeria, I'll be emailing from Nigeria, so I won't be like, I have a big bank account with $15 million, just send me none of that stuff will come through. Okay? So please do read those Nigerian emails, at least for the next 3 days, because they will not contain any information about bank accounts. Okay? So let's pick up where we left off on Monday. In fact, let's go back. 2 sessions ago, we introduced the notion of a regression beta, right? In fact, we argue that most people who use betas in practice get them from services, Bloomberg or Barra. And if you dig a little deeper, they'll say, I get a beta from a regression, because that's the way we're all taught to look at betas. Last session, we argued that regression betas are just the front end, that behind the regression beta, there's a story. In fact, there are 3 factors that determine your beta. What kind of business are you in? The more discretionary the product or service you provide, the higher your beta. How much do you have in fixed costs? The more fixed costs you have, the higher your beta. How much have you borrowed? So at this stage, if I asked you to at least characterize what type of beta your company should have, high, average, or low, you can reason your way to an answer without looking at a regression. But you can't give me specifics. So if I asked you, what's Tiffany's beta going to look like? You're going to say it's a high beta, but then I said how high, you're going to be stuck. So today we're going to nail the coffin shut on regression betas and come up with a different way of estimating betas. And we're going to use the same property we used to come up with the beta for Disney Cap Cities after the merger. Betas are always weighted averages. So if you're a company and you have a collection of projects, and I could get a beta for each project. Again, don't ask me, how can I get a beta? If I could get a beta for each project, your beta as a company would be a weighted average of the betas of the individual projects you take. Now already you can see this is going to be a nightmare. How many projects does Disney take during the course of a year? Hundreds. Small theme park investments, big theme park investments, small movies, big movies. So it's impractical to do it at the project level. So maybe we can aggregate. Maybe if I aggregated projects by division or by group of the company, and I could give you a beta for each division, the beta for the company should be a weighted average of the betas of the different divisions you're in. That's the insight we're going to use to come up with the beta for a company. I call this a bottom-up beta. It's a concocted term that I created when I first started describing it. I said, I'm going to call this a bottom-up beta. And here's why I call it a bottom-up beta. In a regression, it's a top-down regression. You take a company like GE, you run one regression, you get a beta for the entire company. One regression for the whole company. In a bottom-up beta, what I do is I start with the business or businesses you're in, and I build up to a beta for the company by using the betas of the businesses you're in. Let's take a very simple example. Okay? Let's suppose you have a company. So you be the one, you created a company, you're in 2 businesses, you can make up any 2 businesses you want. What businesses do you want to be in?
Shoes.
Shoes, okay. And
jackets.
Shoes and jackets. Not that diverse, but let's make it shoes and spaghetti. Okay, shoes and pasta, good. So shoes and pasta. Okay, good. Here's what I'm going to do. I'll say I'll be back tomorrow. I go back to my office. I find as many publicly traded shoe companies as I can. Probably find about 50. And I find as many publicly traded food processing. You're saying, why not pasta companies? You have to be careful not to get too specific about your business, otherwise you're going to run into trouble. So as many food processing, and I can find 100. So I found 50 publicly traded shoe companies, 100 publicly traded food processing companies. Why did I want publicly traded? Because I can look up a beta for each of them, right? So I can get a regression beta. I know with all its limitations, I get regression betas for the 50 shoe companies and the 100 food processing companies. I take the average beta. Just a simple average, no playing games, no weighted averages. And we'll talk about why no weighted averages in a second, but just a simple average. So now I have an average beta for a shoe company and an average beta for a food processing company. Now these are average regression betas, right? And a regression beta is a function of both the business you're in as well as how much you've borrowed. So a shoe company might borrow very little money, a food processing company might borrow a lot of money, and you might borrow no money at all. So here's what I'm going to do. I'm going to take those average betas, which are levered betas because of regression betas, and I'm going to unlever them. Remember how I did this for Disney? I took out the effect of debt. I'm going to come up with an unlevered beta for being in the shoe business and an unlevered beta for being in the pasta business, the food processing business. I'm almost home. I'm going to come back to you. I'm going to say, look, you told me you were in two businesses. Don't worry, I won't put you on the spot on this. Shoes and pasta. Tell me how much value you get from each of these businesses. Now, your first reaction is, I have no idea how much value I get, but I can tell you how much revenues I get. I get 80% of my revenues from shoes, 20% from pasta. Okay, I can live with that. I take a weighted average, 80% times a shoe beta, 20% times a food processing beta. These are unlevered betas. I now have an unlevered beta for your company. And ask you a final question. How much debt do you have? The easiest answer I can deal with is you have no debt at all, in which case I'm done. My unlevered beta is my levered beta, I can move on. But if you have some debt, let's say 20% debt, 40% debt, I'm going to plug that debt in and come up with a levered beta for your company. Why am I doing all of this? Because I don't like regression betas, right? But where did I get the 50 shoe company betas? I got them from regressions. Where did I get the 100 food processing betas? I got them from regressions. All I've done is replace one regression beta with an average of 50 or average of 100. So what's the big deal? How am I gaining anything by moving from a single regression beta to an average of 100 regression betas? What was one of the things that worried me about a regression beta?
You're getting an industry beta instead of...
But why is that better? So all it is an average, right? You can attach the name industry to it. But why is an average of 100 regression beta so much better than a single regression beta? But that's fine. But tell me how it shows up in terms of, ultimately what I care about is I want the right beta for my company, right? How is this giving me a better beta for my company than using a single regression with the company?
I think we get a better R-square.
It's not so much an R-squared, but remember there was a standard error for the beta that we got when we ran a single regression? Let's say it's 0.25. A single regression. Let's say I have 100 betas, each of which has a standard error of 0.25. They're all crappy betas. I take the average of the 100 betas. You know what the standard error of that average is going to be? It's my favorite statistics theorem. It's called the law of large numbers. Here's what it says. You take 100 crappy numbers, you put them in a pot, you stir them up, you pull the average out. The average is magically precise. I never got this in my statistics class. How the heck can you average 100 crappy numbers and come up with a precise average? The answer is actually surprisingly intuitive. When I say the standard error of a beta is 0.25, what am I saying? Some of these betas are overestimated, some are underestimated. When I average across 100 stocks, I'm going to get a more precise beta because I'm averaging out my mistakes. It's not a finance concept, it's a statistics concept. An average of 100 regression betas is going to be 10 times more precise than a single regression beta. Why 10? The square root of 100. If I have 100 companies in my sample, the average, if I have 50, it's going to be 7 times more precise. I'm testing you on your squares here. If you have 25, you're going to be 5 times as precise. Even if you have only 9, you're going to be 3 times more precise. That's the first selling point I have for bottom-up betas, is they're going to be more precise. Here's the second one. Do companies change their business mixes? Like, he might have been only in the shoe business until yesterday and bought the food business, the pasta business yesterday. There's no chance a regression beta would reflect it because I had to go back 5 years. But when I'm setting the weights for these betas, I can look at what businesses you're in. I can go further. I can be proactive and look at the businesses you plan to be in. Maybe he wants to be in social media tomorrow, in which case I'm going to say, look, the beta you're going to have tomorrow is going to be different. Here's how it's going to be different. I retain or regain power over betas, because I can now look at the business or businesses you're in and change your beta as your business makes changes. So when we talk about bottom-up betas, that is the biggest plus of bottom-up betas. They're more precise and they're more forward-looking. We talked about how the dangers of backward-looking regressions, you're trapped into the company that you used to be, not the company you're today. With bottom-up betas, I retain power over that process. Now, over the next 35 minutes, I want you to hang in with me because I'm going to take you on an expedition. That's a nice way of saying this is more like a torture ordeal, of how to estimate bottom-up betas. And I'm going to use Disney to illustrate this process. It is not complicated, but it's tedious. So you're going to see steps pile up on top of each other. Don't leave me mentally. Just hang in there, because if you get this, you've got one of the building blocks for both corporate finance and valuation. Yes, go ahead.
Do the companies that you use for this estimate, do they have to be primarily in one business?
It's an excellent point. When I said 50 shoe companies, I was hoping and praying they're only in shoes. But the problem is, when I print out 50 shoe companies, guess what's on the list? I'm going to get Nike, which is in shoes but also in apparel. I'm going to get Under Armour, which is in shoes, apparel, and sporting stuff. I've got to hope and pray that whatever is not shoes is going to average out. Average out in what sense? I mean that they're all not in the same direction, right? If some of them are in safer, let's say 70% shoes, 30% everything else, and the 30% everything else is all over the place, the law of large numbers works on that as well. What will get me into trouble is if that 30% of the other business they're in is consistently safer. They've got a financing business that goes with the shoe business. Then I've got to be a little more careful. But it's very difficult to get what I call pure play companies. Now, one of the reasons I'm going to take you on this torturous expedition of Disney is I want to take you through the process of how I estimate bottom-up betas with all the walls I ran into. Because the way I described it sounds simple, right? 50 shoe companies, 100 food. How much easier can that get? You're going to see that in practice, this process can get pretty involved. So I'm going to try to estimate a bottom-up beta for Disney. And you will have to do the same for your companies. So start thinking about your company. First question I have to ask is, what business is Disney in? Or businesses is Disney in? Here's where I went. I went to the 10K. And most companies will have a breakdown of businesses. Some are more diffuse than others. But Disney is pretty clear about the 5 businesses they were in 2013. And as I go through each business, I want to think about what goes in there. Media networks, which is their broadcasting business. What's in there? You've got the elephant in the room, which is ESPN, which is really Disney's driving force for cash flows. You got ABC. Okay? You got Disney Cable. And you also have NDTV, which is this Indian, I think, TV. So they're all in that broadcasting business. That was easy. Parks and resorts, what's in there? This is easy, right? You got Disneyland, Disney World. Euro Disney and Tokyo Disney, they are part of Disney, but they have a very different arrangement. They actually get management fees. Euro Disney, they're actually paid a management fee. And they now have Hong Kong Disney had just come on to operations at the start of 2013. And if I did it this year, guess what else would be in there? You're going to have Shanghai Disney, which opened a few months ago. So it's all the theme parks. You know what else is in this parks and resorts? The cruise, they put the cruise lines in there as well because they felt that the cruise, let's face it, the only reason you take a Disney cruise is to see Mickey. Right? I mean, otherwise, why get on a big boat, pay a 35% premium, and have cartoon characters walking around the boat? Because it's a Disney boat. So they do put the cruise lines in there. They also put all the resorts that they build around the theme parks because they view them as leech properties, which is basically the only reason you stay at the Dolphin is because you want to be at Disney World. There's no other conceivable reason I can think of. Right? So those are all in parks and resorts. Then you have the movie business. This used to be so simple. Just Disney animated movies, but now it includes Disney animated movies. It includes Pixar. It includes Marvel. It includes Lucasfilms. Okay? And the consumer product business for Disney is a catch-all, where they throw anything they can't find a place for, go there. My son actually works in the consumer products division of Disney, so I don't describe it this way to him. But his job is actually to negotiate licenses, or he's part of the team that negotiates, because Disney actually doesn't produce their own toys or software anymore. They license it out, so you've got to pick the right person to license out. So consumer products. And in 2013, they had one new business that was called interactive gaming. That was the division that supposedly, at least in theory, was going to come up with the apps and the games and the software that was the future of Disney. Saying supposedly because if you've been reading up on Disney for the last couple of years, in 2016 they shut down interactive gaming because it wasn't paying off. But in 2013 it was still live. So 5 businesses, and that's what they broke themselves down into. They did give me information in each of these businesses, and this is where some companies are better than others. Some companies will just give you revenues. Disney gave me revenues, operating income, depreciation. So basically they broke down their numbers by business. So that's my raw data. That came right out of the 10K, 5 businesses. My job is laid out for me. I have to come up with a beta for each of these 5 businesses, and I have to come up with a weighted average of these, and then come up with a levered beta for Disney. So let me get this process started, because as I said, I want to take you through the mechanics in some detail, because you will have to confront this, not only on your company, but perhaps on the case that's coming in a couple of weeks. So let me start with the movie business, which was actually an easier business, because I want to talk about how this process works when it's pretty straightforward, and then we'll throw in every curveball we can. So there's studio entertainment. To come up with the beta for the movie business, I looked at US movie companies. Why just US? Why go looking for trouble? I mean, I could open it up, but I have no idea how movie business, the rest of the world, is structured. So I started with the US movie companies. I found 10. You're saying only 10? Remember, even with 10, how much do I save in my standard error? I'm going to save about, it's going to be 3 times more precise. Would I rather have 100? Yeah. Would I rather have 1,000? Even better. But if I can get 10, that's good enough for me. And here are the 10 movie studios that showed up on my list. So there are the 10. They're all publicly traded, so I pulled up the regression betas. You can do this on Bloomberg, you can do this on S&P Capital IQ. I pulled up the regression betas. Regression betas are levered betas, right? So in addition to pulling up the levered betas, I pulled up the market cap of each of these companies and the total debt of each of these companies. So I wanted to see how much debt they had. And I also pulled up how much cash they had as companies, and you'll see in a minute why I care about that. So basically, here are the numbers I pull up when I do my Capital IQ search of Bloomberg. I find the comparable companies, I pull up the regression betas, market cap, total debt, and cash. If I add the market cap to the total debt, I come up with what I call firm value. This is the value of the entire balance sheet of the companies. In market value terms, it's whatever is on the balance sheet. And if I subtract out cash, I get what's called enterprise value. Enterprise value, it's a market's estimate of the value of the operating assets of a company. So those are computed numbers. So total debt, market cap, and cash are the numbers I pull off. Market cap plus debt is firm value. Market cap plus debt minus cash is enterprise value. That's the raw data that I had. I have to take this raw data and come up with an unlevered beta for the movie business. So here's the first thing I did. I computed an average beta across the companies, and I did averages for both the beta and the debt to equity ratio. So basically the debt to equity ratio is total debt divided by market cap, and my average beta was 1.35, and my average debt to equity ratio was shockingly high for a movie company, 129%. But take a look at why it's so high. I've got one fruitcake company, 551%, actually 2, 551%. So you have 2 big outliers, companies on the verge of disaster pulling the average out. And I remembered my statistics class. Averages are dangerous when you have outliers, right? There are 2 ways you can deal with them. One is a very dangerous way of doing what? Taking your outliers out. Don't play that game, because before you know it, you'll have no sample left. Because everything will start to look like an outlier after you start. So I don't go there. So I did what is a much more defensible thing, which is if the averages are getting pulled by the outliers, I computed the median value. The median is the midpoint. The median beta for movie companies 1.24. The median debt to equity ratio is about 27%. So I'm okay with those numbers. First thing I did was I'm going to take those median betas and median debt to equity ratios, and I'm going to come up with an unlevered beta for being in the movie business. And that's the first thing I computed, is I took the median beta, 1.24, the median debt to equity ratio, and I came up with an unlevered beta for being in the movie business of 1.07. And if you want 4 decimals, 1.0668. That adds a layer of precision if you feel like adding it on. 1.07. I used to stop there. Until about 15 years ago, I would say that is the beta for a movie company. But I realized about 15 years ago that I was lying. Why was I lying? Because a typical movie company is about 97% movies and about 3% cash. And that's why I collected the cash as well, is to see how much cash they had. You're saying, who cares? When you have cash as a company, the cash is a beta of 0, right? What I've computed as an unlevered beta for a movie company actually reflects the beta for the whole company, but I want a beta for just being in the movie business. So I took the 1.0668. I said the beta of cash is 0, so effectively I've got to load up all of this beta on my movie business, and I came up with an unlevered beta for being in the movie business of 1.099. That is going to become the unlevered beta for the movie business. I know there's lots of steps, so let me go through the layers again. First step is I look for comparable companies. I found 10. Second step was I collected the raw data, beta, market cap, total debt, and cash. And I computed the firm value and the enterprise value. Third step is I took the median beta and I unlevered it using the median debt to equity ratio to come up with an unlevered beta for being a movie company. Final step, I took that unlevered beta for being a movie company and came up with an unlevered beta for being in the movie business. And that's the beta of being in the movie business. Question?
Why do you take the median of the whole industry and then unlever it rather than
Unlever and the median? No particular reason. I'll tell you why I prefer. Did everybody get his question? Which, if you go back to this page, I could have done an unlevered beta for each company, right? Because I have a beta, I have a debt to equity ratio. I was just following a very simple rule, which is when you have a noisy number, doing mathematical operations on that noisy number will make it even noisier. You're saying, what are you talking about? We said the regression beta, an individual regression beta can be all over the place, right? So if I take an individual regression beta that's screwed up, and then I do the unlevering and cash adjusting on that beta, I'm going to exaggerate whatever that screw up is. So what I'm trying to do is average first, so I can get rid of the screw ups, and then do one unlevering. So it's not even a financial rationale, it's purely a statistical or mathematical rationale. It gives you more precise answers because you don't get these strange betas being pulled into the stratosphere. Yes?
What's the aggregate?
Aggregate is I just added up all of the debt of all of the companies, so that's the other way you can deal with outliers, right? Instead of it's like a weighted average. That's a way to think about it. Basically, it's like a weighted average debt to equity ratio. But it doesn't have the problem of a small company with a huge amount of debt pulling the entire sector up. Okay? So if you don't like medians, you say that's too sloppy, I'm just taking the midpoint, I'd prefer something else, then you can use the average beta with the aggregate debt to equity ratio. Because the debt to equity ratio is where you're going to get the big outliers to clean up for it. So all it is the sum of the debt divided by the sum of the equity across all of the companies in the sample. Yeah? No, the averaging of the beta is what gets rid of the error. So you still have to average the beta. You can't take an aggregate beta. The beta is where the error is. It's not in the debt to equity, right? So basically, that's where you're trying to get the precision is in the averaging there. Right? Yes?
I'm just wondering about these companies. These are, many of them I think are in other things besides movies. If we're splitting Disney up, is there any sort of correction to the fact that these...
You know what you'd have to do? I'll tell you what you have to do, and you're not going to like it. Right? You'd have to go into each company's 10K. You look at what percentage of their value comes from movies, and then you look at what other businesses they have. It's like solving a gigantic algebra problem every time you want to get an unlevered beta and clean up for it. The larger your sample, the less you should care. And that's another reason you want big samples, is when you have a sample of 7 or 8, not only are you going to be worrying about stuff like that, you're also going to be worrying about what index am I running the regression again? Am I using weekly or monthly? All of your estimation sloppiness will get averaged. It's one of the great things about the law of large numbers. You can be incredibly sloppy and end up with a precise answer because the large numbers take care of it. But that's a good point, because this actually wasn't most of these businesses are primarily movie businesses. There are a couple there which are on the edge. It's much more troublesome when you do something like apparel, right? There's a lot of other stuff that comes in. So there you might have to worry more about pure plays, but you have to take what you can get with the data. And this is basically as close as you can get to a pure play beta with companies. Okay? Any other questions? So I have a beta for being in the movie business. That was my easy beta, if you can believe this, because the companies were there. I was able to use the numbers. We go back to my table and talk about my difficult groups. We started the broadcasting business. When I think of broadcasting companies in the US, there are 4 big names that come to mind. The 4 big networks are ABC, CBS, NBC, and Fox, right? Already you can see why this is going to be a nightmare, because if I look at them, ABC is owned by Disney. CBS then was owned by Westinghouse, wasn't a standalone company. NBC was owned by GE then, you couldn't even find it with a magnifying glass. And Fox is owned by News Corp, and nobody can find anything in that company. It's like a gigantic, Rubik's Cube. So already you can see that when I first looked for broadcasting companies, my sample size was 0. That's not good in the law of large numbers to have a sample size of 0. Desperation time. So here's the first thing I try when I hit this desperation point. I went up and down the food chain. Let me explain. The broadcasting business is companies that feed into it and companies that feed out of it. Let me give you a couple of examples of companies I ended up using in my sample. I looked at Nielsen. Nielsen is a company that does ratings, and basically they get the revenues from broadcasting companies. And I looked at the company that syndicates Jeopardy and the Oprah show. I'll come up with the name sooner or later. It's a company that syndicates shows, sell them to the broadcasting companies. Why am I doing this? Because remember, when you talk about comparable companies, you're trying to find companies that do well when you do well and do badly when you do badly. It's not an SIC code or a sector you're so focused on. It's what are the companies that do well when I do well and do badly when I do badly. I ended up with a sample of about 26 broadcasting business companies. Not broadcasting companies per se, but broadcasting business companies. I did exactly what I did with the movie business once. So the biggest test for me here was to come up with that sample of 26. And because I was willing to go up and down the food chain, I was able to expand my sample to bring in enough companies into my sample. I took the average beta, unlevered it. So basically think of the steps. Unlevered beta, came up with the beta for being in the broadcasting business of 1.03. So the only way I could get around the fact that I had a small sample was by expanding my sample by going up and down the business chain. Then I looked at the theme park business. Go ahead. That's a good question. I don't usually screen for size. There are some people who do. But when you screen for size, what are you also implicitly telling me? That you think that small companies in this business will have different betas than large companies, right? Is that possible? In some sectors it is, right? With the economies of scale, for instance, small companies in a business might have higher fixed costs than large companies. They might end up with higher betas. It could also be that small companies in a business sell niche products. And larger companies are more diversified. Niche products tend to be more discretionary. If in some sectors, I will put a market cap screen. So if you're in the steel business, for instance, and you're a very large steel company, I don't want to bring in a $50 million steel company. I'm going to put in a market cap limit. But here's what I'm going to check. When I put that market cap constraint, I want to make sure I still have a sample size I can live with, right? So if I put a market cap constraint of 100 billion, I might find nothing. 10 billion, I might find only 3. So some of this you might have to play with what constraints you can put in and still end up with a reasonable sample size. Because the law of large numbers does require large numbers, stating the obvious. So I can't put in the constraints I'd like to and end up with a sample size of 2. I might have to, that's the advantage of playing with something like Capital IQ, is you can set up the screening cap, see what you get as a sample size, and then tweak them to end. But I think you can add whatever constraints you want. And if you have a big enough sample, like the retail business in the US, I can add all kinds of constraints and still end up with a large sample. So depending on the sample size, you get more degrees of freedom or less degrees of freedom on that. So I have an unlevered beta for being in the broadcasting business. Let's move on to the theme park business. Initially, I looked for other publicly traded theme parks in the US, and I ended up with two. One was Six Flags, which is a disaster waiting to happen, and I don't want to touch them. The other is this Midwestern Cedar Point, is it Cedar Point? Okay. A Midwestern amusement park company. Sample size of 2, even if I trust both, is not a large enough sample size. So here I tried my second device, and usually one of these two usually works for me. First is go up and down the food chain. The second is to go global. In S&P Capital IQ, again, the way this works is you can ask for a screen initially of just US companies. If you don't find enough, just make it global. And I ended up with about 20 companies in my sample. Many were smaller European amusement park companies, but they're publicly traded. And I came up with a median beta, median debt, did everything I did with the movie business. The unlevered beta of being in the theme park business was 0.70. So the key step here is to make sure that that initial screen you're getting a way of coming up with comparable companies, because the rest is pure mechanics. Okay? Now with the global companies, I did run into a bit of an issue. If I said all US, every beta was estimated against the S&P 500. I didn't have to worry about it. But when I asked Capital IQ for betas in other countries, it actually estimates the beta against the local indices or an emerging market index. Now, if my sample size was small, you know what I'd have to do? Is I'd have to go into Bloomberg, pick each company, change the index to the MSCI, some common index, so I can get a beta that is actually comparable across companies. But if my sample size is big, I'm not even going to bother. I'm going to wait for the... See how much I trust the law of large numbers? It's going to be crappy, but it's all going to get averaged out anyway. And the nice thing about betas, and the reason you can go across the globe, is unlike currencies or interest rates. What's the average beta across all US companies? Come on, you don't have to wait too long. It's 1. What's the average beta across all African companies? It's 1. Do you see where I'm going? So if I picked a Nigerian consumer product company and a US consumer product company, I can't compare the PE ratios or their interest rates, but I can compare their betas. Betas are measures of relative risk, and because of that I can go global. And that is what I have as an advantage now that I might not have had 20 or 30 years ago. 20 or 30 years ago when I did this, I had to stick with US company betas because I had no global database. Today I have 42,200 companies. And no matter what company you come up with, I should be able to find comparables if I define comparable broadly enough. So I end up with an unlevered beta. The consumer products and the interactive gaming businesses, I actually had pretty large samples I could use and have an unlevered beta for each of those. So I have unlevered betas for the 5 businesses that Disney is in. You think 5, that's a pain? Just thank God it's not GE, right? There'd be 26 businesses. You'd have to do each one separately. So many of your companies, I wouldn't be surprised if you have 3, 4, or 5 businesses. You've got to get the beta for each one. Any questions about the mechanics? Okay. Just do it a step at a time. Don't jump steps. Don't try to do 2 steps at one time. Find the sample, get the regression betas, get the debt to equity ratios, unlever them, clean up for cash, basically take out the effect of cash. You get a pure play beta for each business, and you're ready to go to the next step. What's the next step? After I have the unlevered betas for the 5 businesses, I need to weight them, right? So here's what I did. I started with the information that Disney gave me, which were the revenues by business. Now, if I were in a hurry, I would just use those revenue weights. But when I use revenue weights, what am I implicitly assuming about the value of revenues in each business? That is the same, right? Every business, $1 in revenue in the movie business, $1 in revenue in the theme park business are all equivalent. And that's not always true because you have high margins in some businesses and low margins in others. High growth in some businesses and low growth in others. The value can be much higher in the high margin, high growth businesses than in the low ones. I don't want to do a full-fledged valuation. So here's what I looked up for those comparable companies in addition to the unlevered betas. If you go back 2 pages, remember the enterprise value that I computed for each company? Market cap plus debt minus cash. I divided the enterprise value for each company by the revenues of each company. So in the last column, you get that ratio. What am I computing there? I'm looking to see what multiple of revenues companies in this sector trade at. And across the 10 companies, the median number I come up with is 3.05. You're saying, what does that even mean? If I trust these numbers across movie companies, the market's willing to pay $3.05 for every dollar of revenues. Why? None of my business. I don't care. That's what it's paying. But if you ask me to dig, it's probably because margins are higher, growth is higher, something is driving those multiples up. It's $3.05 for every dollar of revenues. And I did this for each of my 5 businesses. Do you see where I'm going to go next? I took the revenues I have for the 5 businesses. I multiplied by that number. So the 3.05 would be the multiple of revenues a typical movie company trades for. And I get a value of each business. It's one additional step beyond the revenues, and it allows me to convert the revenues into estimated value. If you don't like to use revenues, you can use EBITDA by business. You know why I don't? Revenues have one really good quality, which is they cannot be less than 0. EBITDA can be negative, and if you have a negative EBITDA, using any multiple of EBITDA is going to give you strange looking numbers. So revenues will always get positive weights, which is a characteristic you want when you do this. So end up with an estimated value of each business. You use those estimated values. Here's what Disney looks like to me. In 2013, if you ask me to characterize Disney as a company, it's about 49% broadcasting, it's about 34% movies, about 13%, I'm sorry, 33%, 34% theme parks, about 13% movies, and the rest is, penny change, 2% in consumer products. 10 years ago, Disney used to have a pretty hefty retail business. They used to have hundreds of stores across the world. They've shut most of them down. There are still a few flagship stores left in big cities, but they're more like fronts. They're more like advertising than stores. So 10 years ago, if I had done this, there would have been a retailing business in there. Businesses come and go. And one of the advantages of bottom-up betas is I can reflect the businesses you're in, not the businesses you used to be in. So there are my estimated values, there are my proportions. I use those as my weights to come up with an unlevered beta for Disney as a company. I told you there were layers upon layers of stuff. So basically, I have the unlevered beta for each business. Now I'm trying to estimate a value for each business, because those values are going to become my weights when I come up with an unlevered beta for the company. Actually, let me take that back. That's not technically true. That's the unlevered beta for Disney's operating part of the company. You see what else is left out? I left out Disney's cash balance. Disney does have a cash balance. I've kind of kept it to the side. If you ask me what's the unlevered beta for Disney as a company, it's going to be 0.9239 times a proportion of its value that comes from its operating assets, plus a beta of 0 for cash, times the $3.93 billion in cash they have. The unlevered beta for Disney as a company is lower than the unlevered beta for Disney's operations because cash is a beta of 0. So I have an unlevered beta for the company, I have an unlevered beta for just its operating assets. I even have an unlevered beta for each of the 5 businesses it's in. What's the last step? I have an unlevered beta, I need to lever it, right? To lever it, what do I need? I need a debt to equity ratio. And what does a debt to equity ratio have to be based on? Book value or market value? It has to be based on market value. And I'm going to have a problem even before I start this process. You see why? Because I have a market value for Disney as a company. I have the total debt for Disney as a company. I don't have a market value for each of the 5 businesses. And I don't have a debt allocation across the business. Disney does not break its debt down by business. It borrows money as a company, and money is then fungible. It goes out wherever it goes out. So I know the debt to equity ratio for the entire company is 13.1%. So that's a total debt divided by the market cap of Disney. That's the one number I feel pretty sure about. And the first time I wrote, so this is actually the 4th edition of my Applied Corporate Finance book. I've done Disney through all 4 editions. The first edition, I was lazy. I'm still lazy, but a little less lazy maybe now. And I said, I don't have debt by business, so I'm going to give them all the same debt to equity ratio. And I got a lot of heat for that, especially because you can see why, right? If you look at these 5 businesses, you can see they're very different businesses. The theme park business is very different from broadcasting. Attaching the same 13.1% debt is a little dangerous in this process. So I decided about 3 editions ago that I had to try my best to allocate the debt across the businesses. And here's how I went about doing it. I knew what the total debt for Disney was as a company, $15.96 billion. They also broke down what they called identifiable assets, physical assets in each business. I made the assumption, and this is my assumption, that the debt was probably in proportion to the physical assets. That you borrow money for physical assets, you don't borrow money for what you might call intangible assets. When I allocated the debt across the 5 businesses, I came up with the debt by business. For the value of the equity, here's what I did. If you go to the previous page, remember I valued each business using that multiple of revenues? I took that as the value of the business. You subtract out the debt, you get a value of equity in each business. I used those 2 numbers to come up with debt to equity ratios, and you can notice, if you look at the differences, that the consumer product business has a huge debt to equity ratio. Why? Because they have a lot of debt allocated to them because they have physical assets. And actually, if while that might not look like it makes sense, if you think about their business as being licensing, it's actually a very predictable business. They license a product out, the income is very predictable. So I'm not surprised the debt to equity ratio is much higher. So because Disney is in such diverse businesses, I'm trying, and I don't know whether my allocation is right. You might decide to use something else to allocate the debt. Give it a shot. It could be based on depreciation if you feel that's a much better measure of how debt is allocated. But I'm ending up with different debt to equity ratios. I plug those in, and I come up with a levered beta for each business. So the unlevered beta that you see there comes from this page. It's basically the unlevered beta from this page. The debt to equity ratio is from there. I have a levered beta for each business and a levered beta for Disney as a company. So the only debt to equity ratio that I actually get to observe is the company's overall debt to equity ratio. The other 5 are based upon my allocation mechanism, but I now have a levered beta for each company. And once I have the levered beta, the cost of equity is risk-free rate plus beta. So it's the risk-free rate and equity risk premium part of the discussion haven't changed. The risk-free rate, I'm going to use the US dollar risk-free rate. Why? Because I'm doing everything in US dollars, so 2.75% of the time that I did this. For the equity risk premium, I use the 5.76% premium, which is the risk premium for Disney across the countries they operate in. So there's my cost of equity for Disney as a company, 8.52%, and the cost of equity for each of the 5 businesses. From this point on, you're never going to hear me talk about Disney's regression beta. What was Disney's regression beta? Do you even remember? It was 1.25, right? Which if you plugged in, came up, gave me a cost of equity, and we did this song and dance of a cost of equity. I am not going to talk about that beta because I don't trust a regression beta, a single regression beta. From this point on, if you ask me what's the cost of equity for Disney, my answer is going to be based on a bottom-up beta, and that bottom-up beta delivers a cost of equity of 8.52%. It's going to be more precise. It's going to be more forward-looking. It reflects Disney as it exists today, and it comes with a bonus. And here's the bonus. In addition to giving you a cost of equity of the whole company, I now have given you a cost of equity for each of Disney's 5 divisions. And this, to me, is at the core of running a multi-business company. Because I'm going to pose a question to you, and you're going to see why knowing the cost of equity for the 5 businesses is going to help you if you run Disney as a company. So I'm going to let you play a role. You be the CFO. It's such a boring role. I'll be the movie guy at Disney. It's so much fun. So here's what I do. I come up with these outlandish ideas, and I ask you to fund those ideas. So what's your job? To say no. That's why it's a boring job. So you have that job. I'll have the fun job. So I'm going to come to you with a movie project, and I'm going to characterize the movie project, and I'm going to ask you, would you fund this project? And along the way, you're going to have to confront what your hurdle rate is, what your cost of equity is. So here's the name of the movie, Lone Ranger 2. This time it's not Johnny Depp. That's actually going to be put into the title to be very clear. So I come to you, it's going to be a big budget movie. It's going to have Tom Cruise as Tonto. No. So basically it's going to be a $250 million movie. I want you to fund the movie. You get ready to shut the door in my face the minute I say Lone Ranger 2. I say, wait. This time we've looked at the numbers, which tells you a little bit about last time, but let's not go there. We've hired 3 MBAs from UCLA. It's close enough. They would have gone to Stern, but too far away. on an internship project. They worked through the numbers, and they've told us that we can make a 9.5% return on equity on this movie. No movie guy ever talks like this, but act like I do. So here's a question for you. Would you take this project with a 9.5% return on equity? And I'll take you back to the previous page to see why I picked the 9.5% return on equity. It is higher than the cost of equity for the whole company. But it is lower than the cost of equity for the movie business. See the question I'm asking you? When you make, when you make that judgment on whether to fund the project, would you use the cost of equity for the company, which after all comes up with the capital, or the cost of equity of the business? How many think it should be the cost of equity for the business? Okay. How many think it should be for the company? Okay, I'm going to put you on the spot because I think we can flesh. Don't worry, I will flesh out the part because let's see where this will take us. Because if you make that judgment, you're basically saying that every one of the 5 divisions should have an 8.5% cost of equity, right? Any project you take, anywhere in the company, should have an 8.5% cost of equity. Let's carry this to the next step. If I decide to do that, have one cost of equity for the entire company, and you're in good company, half of all US companies use one cost of equity for the whole company. Let's see the consequences of doing that. Which of these 5 businesses is going to be happiest about the decision you made, and which one's going to be really pissed off? Let's start with which one's going to be pissed off. Which of these 5 businesses is going to be pissed off by having one cost of equity across the business? And what is it about parks and resorts that's going to piss them off? They're a safe business, and what am I doing? I'm imposing a much higher cost of equity. All the riskier businesses are going to say, this is wonderful. They'll find the family feeling. So let's carry this to the next step. If I use an 8.5% cost of equity, my riskier businesses are going to find a lot more projects. They're going to grow more. And my safer businesses are going to shrink on the vine. So 5 years from now, when I look at Disney, what is it going to look like? The safe business is going to have become a smaller percentage, maybe even have disappeared, and my riskier business is going to have risen. It's almost inexorable, right? If you pick one cost of equity for any multi-business company, risky parts of the company will grow too much. And why are they growing too much? Because in a sense they're being subsidized by the safer parts of the company. Your cash cow can be milked only so much, and if your subsidy can last only as long as a safe business lasts. You're going to drive it into the ground. As I said, half of all multinationals have this problem, and they wonder why it happens. Why do our riskier businesses keep getting bigger? It's almost given if you pick one cost of equity for the business. So the right thing to do is to use the cost of equity of the business. And in fact, if you want to slice and dice this, you could actually argue that maybe the action movie business has a different cost of equity than the animated movie business, as opposed to the art movie business. The art movie business, nobody gets to see the movies, so you've got to figure out other ways to make money. The action movie business, everybody in Asia wants to come out and see, so maybe that reduces the risk. You could do all kinds of finessing here, but the reason you're doing it is you don't want safe parts of your company subsidizing riskier parts. So it seems like common sense, right? Any multi-business company should be using hurdle rates that reflect the risk of the business where a project is, rather than the overall risk of the company. So how come so many companies still hold on to one cost of equity for the entire company? One is legacy, it's always been done. What else? How do we say most people get betas? They look it up on a service or they run a regression, right? If the way you get a beta is by running a regression or looking it up in a service, how many betas am I going to get for GE? I'm going to get a beta for the whole company, not for GE Capital, GE Aircraft. So the way we estimate betas is by running a regression. You're trapped. You're going to get one beta for a company. So that's the second problem. What else?
Investors usually use one cost of equity.
That doesn't matter. Investors can use one cost of equity. You still have to, as a company, do better than that. So maybe that's the rationale. If they use one cost of equity, as long as we beat it, even if we're taking riskier and riskier business to beat it, we're fooling some of the people enough of the time that we can get away with it. Maybe that's it. There's also, what else?
Perhaps the brand halo effect, if there is a success in one area of business, that it elevates.
that's a good argument. That's a cash flow story, right? Basically, it's not a risk story. So maybe when the movies do well, the theme parks get cash flows. So when I do the cash flows, I'll still give you the benefit of that halo effect, but it shouldn't be double counting. I shouldn't be lowering your discount rate as well, because then I'm counting the same benefit twice and perhaps the second time incorrectly.
If movie tanks though, then perhaps the theme parks will also be punished.
It's possible to the extent that they're all, so maybe you could argue that maybe Disney's all one company. That basically if the movies do badly, nobody watches ESPN. That's the tough one that'll be there. But basically if they're all connected, you could argue that some companies that look like multi-business companies are really single business companies, right? I think that's less and less true for Disney as it goes along, but at one point in time, I think you're absolutely right. The theme park business and the movie business, there were two businesses, were locked at the hip, right? Yeah.
So it depends on how your capital allocation decision is done. If it's centralized, then
Yes.
do after.
There's nothing convenient about using one cost of equity. It shouldn't be a function of whether it's centralized or not. The problem with centralization sometimes is that the centralization might lead to this inertia, which is you do the same thing. You don't think about the riskiness of the business level because you're so disconnected from the businesses. Okay. Do you think there's some blowback when you try to impose different costs of equity for different businesses? Let's play it out here. Right? When you decide to tell these businesses they're going to have different costs of equity, do you think some of these businesses are going to get really pissed off at what you're trying to do? And I'll tell you a story to bring this home. About I'm getting old, 26 years ago, somebody from this class graduates, goes to work for the Gap. At that time, incredibly growing retail business. And she calls me about 3 months into a job, and she's very excited. She says, Gap, we're opening these new divisions. At that time, at the time she went into the Gap, it was just one store concept. It was a Gap store in a mall. That was a typical investment. Every single store looked exactly like the previous investment. They used an 18% hurdle rate. Where did that come from? God only knows, but they used it across the board. And she said, we're going to create two new concepts. One is this notion of a discount store, which we're going to call Old Navy. And the other is this high-end Gap store, we're going to call it Banana Republic. And then she said, as we start these businesses, we think, she said, I remember my corporate finance class, and I said, I'm glad somebody does. Okay? And the discussion of discretionary non-discretionary, see how long I've been repeating the same stuff. She said, well, if you think about discretionary non-discretionary, these divisions should have different. So lead me through the logic. Which of these three divisions, if you think about the Gap, Old Navy, and Banana Republic, which one? So let's assume the Gap is the 18% hurdle rate company. Now you're creating two new concepts. Which of these two extra divisions is going to have a higher cost of equity? Let's face it, Banana Republic is Gap clothes marked up 35%, but you don't have to deal with the riffraff. So basically it's a price. And Old Navy is Gap clothes discounted by 35%, but you have to deal with a lot of the riffraff. So basically it's up and down the discretionary chain. So we talked this through, and she came to the conclusion that she should be pushing for a 21% hurdle rate at Banana Republic and 15% for Old Navy. And she said, there's a divisional head meeting next week, I'm going to bring this up. I knew exactly what she was walking into. And I said, okay, call me after it's done. Let me know how it goes. So she calls me after it's done. She said, it did not go well. One of the divisional heads absolutely hated the idea. So let me guess. Was it the Banana Republic guy? He said, yes, he absolutely. He said, this is terrible. They're part of the Gap family, and this is very unfamily-like to demand a different discount rate. And I said, what did the CEO say? At that time, it was Mickey Drexler, one of the legendary. Mickey really wants this division. He likes this division. He wants it to succeed, so he decided to let it ride for a couple of years. And that's precisely what a lot of companies do. Is often the riskiest businesses are your highest growth, your glamour businesses. And you don't want to get in the way, you don't want to anger anybody. So in the sense, you say, let's put this off. We know it makes sense to demand a higher hurdle rate, but now is not the time to do it. JP Morgan went through this. And banks are actually the worst culprits on this front. Because there was a time when banking was one business. Now if you look at banking, you got investment banking, you got trading, you got private equity. You could argue that banking is perhaps one of the most diverse entities you can think of in terms of risk, that you should have different costs of equity for each of these businesses. It makes no sense to me that commercial banking and private equity have the same cost of equity. JP Morgan spent a year trying to come up with costs of equity by business in JP Morgan and finally gave up. Not because they couldn't come up with the numbers, but because they could not get the divisional heads to buy in. And the CEO didn't want to rock the boat. To me, this is corporate finance 101. You're a multi-business company. You have to start thinking about different hurdle rates for different businesses because you've got to hold them to different standards. You can't demand one cost of equity across the board. But the reason we're able to do that is we use the bottom-up beta approach. That's why I call this the bonus you get out of the process. Any questions? So let's try this for other companies. So I took Vale, and I'm not going to take you through the tedious detail that I did with Disney, but I broke it down, I let them break themselves down into 4 businesses. And here are the businesses they broke themselves down into: metals and mining, iron ore, fertilizers, and logistics. For the comparable companies, I went global with all 4. The reason I went global is once you go to markets like Brazil, if I stay local, my sample size is going to be tiny. So I use global mining companies, global iron ore companies, global chemical companies, and global transportation companies. Look at my sample sizes. So I have the law of large numbers working in spades, especially with fertilizers, 693 companies. There's the unlevered beta for the companies in the business. There are my revenues that Vale gets in each business, my estimated value. At least based on my estimates, Vale is about 76% iron ore, about 17% metals and mining, and the rest is fertilizers and logistics. The unlevered beta that I get for Vale as a company is 0.844. Again, I can apply debt to equity ratio, and here I didn't waste my time trying to allocate debt. These are all 4 capital intensive businesses. There's very little basis for me. They didn't break down by assets. So I took the 54.99% debt to equity ratio that I had for Vale and applied it for all 4 businesses. Already you can see that I'm going to give you degrees of freedom on your company. I'm going to let you make the judgment on your company as to whether your company is more like Vale, and you can attach the same debt to equity, or whether it's more like Disney. There is no right answer. I say you have to do this. It depends on your company. And I end up with a levered beta for the 4 businesses and a beta for Vale. And you can see with Vale, if they use one cost of equity, the consequences are relatively small because their businesses are all about the same risk. You don't have a 1.8 beta and a 0.5 beta. And I end up with a levered beta for Vale of 1.15. With Vale, I don't know whether you remember, but I said I'm going to do everything in US dollars. Why? Because it's a commodity company. It reports everything in dollars. Why mess with those financials, convert them into reais? The cost of equity I end up with for Vale as a company in US dollar terms is 11.23%. And just a reminder, my equity risk premium comes from where? It comes from where Vale does business. And its biggest market is? Come on. China, right? 37% from China. And that's reflecting the equity risk premium. The luxury we have now that I didn't have 20 or 30 years ago when I first started doing this, was when I had to pull comparable companies together, I had to go company by company, pulling the betas, putting them in an Excel spreadsheet. Give give Capital IQ a shot. If you haven't used it yet, use the screening tool. It's amazing how powerful it is in terms of pulling up comparables, where you can try different criteria to decide what you want as comparable companies. So I have a cost of equity for Vale in US dollars. Let's say at this stage in the process, and this could happen to you. So you're 5 weeks into the class, you have a dollar cost of equity for your Colombian company, and you decide you'd rather do everything in pesos. I want to convert my cost of equity very quickly from US dollars to reais here. Let's suppose I want to do everything in reais. What do I need to do? Remember that inflation differential we talked about when we talked about currencies? That the reason you have different numbers in different currencies is because you have different inflation rates. My dollar cost of equity is 11.23%. And if I can estimate, and I should be able to, an expected inflation in US dollars of 2%, And if I can estimate an expected inflation in Brazil, a lot more difficult, but if I can, of 9%, my US dollar cost of equity of 11.23% will become a real cost of equity of 18.87%. There's a compounding effect. If you're in a hurry, you can just add the 7% onto your US dollar cost of equity. You get 18.23%. It's an inflation adjustment that gets you from one currency to another. So if you've computed a cost of equity or capital in any currency, converting it into any other currency becomes trivial. It's just the inflation difference that you've got to bring in. And you've gone from one currency to another. Any questions on Tata Motors and Baidu? I had an easy time because I put them both in single businesses. Tata Motors I treated as an automobile company. I looked up the beta for global automobile companies, not just Indian automobile companies. The sample size is too small. I ended up with a beta for an automobile company of 0.8601, 76 publicly traded auto companies. But then I used Tata Motors debt to equity ratio, 41%, and Tata Motors tax rate of 32.5%. And that's a marginal tax rate because you're talking about the interest tax deduction. Came up with a beta of 1.10. Cost of equity in rupee terms for Tata Motors, risk-free rate of 6.57%. That was way back in class, but we took the government bond rate and netted out the default spread. Beta 1.10, and the equity risk premium for Tata Motors as a company. So the risk-free rate carries a currency burden. The beta tells you what businesses you're in, and the risk premium reflects where you do business. Yes?
So I'm guessing you didn't include Tata Motors in your 76?
That's a good question. Normally in statistics, you're supposed to take out your one company from the sample. If you have 76, I'll say don't waste your time. If you have 7, I would take it out. Again, another bonus from having a law of large numbers. I told you, you can be sloppy and get away with it. With 76, it's not going to make a difference, but with 7, it should. But as a general principle, you shouldn't count your company in the sample you're using. But with 76, I don't even remember whether I checked. I usually don't even check. With 76, law of large numbers will work out. I'll make mistakes. I'll put a decimal wrong place. Everything. No. So it usually does. With Baidu, I use the beta from online advertising companies. But it's a search engine company. This is something that, yesterday when I had the misfortune, actually, I didn't want to do this. I ended up on CNBC talking about Snap. And the discussion is it a camera company? Is it a social media company? And my point is it's neither. It's an online advertising company. Because to me, when I think about businesses, I think about how you make money. A search engine is how you set up your business, but let's face it, Google makes its money from advertising. The search engine by itself is not what makes it money. So I used online advertising companies because Baidu is very much like Google. The unlevered beta is 1.30. I did use Baidu's debt to equity ratio of 5.2% and the marginal tax rate for China. So what I'm doing is I'm using the unlevered beta for the business you're in, but it's still your tax rate and your choice on debt that drives your levered beta. In the case of Baidu, that translates into a cost of equity of 12.91%. So it's a lot of work to get there, but once you get there, you now have the freedom to change that beta as the business changes, the business mix changes, the debt to equity ratio changes, you retain control. Finally, I looked at Deutsche Bank. I broke them down into two businesses, commercial banking and investment banking. For commercial banking, I used other European banks. You're saying, why don't you go global? There are differences still in how banks are regulated around the world, at least on the commercial banking side. So I chose to use European banks. For investment banking, I use global investment banks because in much of Europe, investment banking is done by the commercial banks themselves. So standalone investment banks are much more of an Anglo-Saxon phenomenon, so I had to bring them in. So I had 84 banks and 58 investment banks, and I did a median beta. And I used that. What's the step I seem to have skipped? I didn't unlever and relever. Why do you think I didn't do it? What do I need to unlever? I need a debt to equity ratio. Try getting that for a bank. What's total debt for a bank? I have no idea. It's everything could be debt or nothing could be debt. Debt to a bank is really not a source of capital. It's raw material, right? Because if you're a traditional bank, what do? You borrow money, you lend it out. You can't think of debt to a bank the same way you think of debt to a manufacturing company. So whenever you see me talk about Deutsche, you'll see me kind of focusing on the equity because it really doesn't make sense for me to unlever or try to underlever and relever. It makes my job easier, actually, right? But I am implicitly assuming that leverage is not where the big differences across banks occur. It's perhaps in regulatory capital or the loans you make. That's the factor you might want to control for. But the beta that I ended up with for Deutsche, so weighted average of those two is 1.15. And since I'm doing everything in euro terms, I have a euro risk-free rate, the risk premium for Deutsche, and the levered beta for each of these businesses. So with financial service companies, and I would extend what I said about banks to insurance companies, investment banks, don't even waste your time levering and unlevering. You're going to drive yourself crazy. Just take the average levered beta across the business, just continue to use it as your levered beta, and hope and pray that your bank hasn't done something incredibly stupid. Now here's the final advantage of using bottom-up betas. To value Snap last week, I needed a beta, right? So I could go to Bloomberg and look up the beta for Snap. What am I going to find? Nothing, because it's not traded yet. GE, trying to sell off GE Capital. You got to value GE Capital, you go looking for a beta for GE Capital, you're not going to find it. If your only device for getting betas is to run a regression, you're trapped. You can't get the betas for IPOs, you can't get the betas for private businesses. But with bottom-up betas, you can get around that. So I'm going to use an example to kind of illustrate this, and this is actually an example that comes out of something that happened to me about a long time ago. Sitting in my office, a lady walks in and she says, somebody told me I should talk to you. And she said, I own a bookstore in New York City. This is the original idea that gave me Bookscape to use in my book. And I've changed the name of the bookstore. She said, I own this bookstore. And I said, I recognize the name. I come into your bookstore all the time. She said, I'm facing a fight or flee decision. The first reaction is, maybe you should be talking to the FBI. I had no idea what she was talking about. She said, no, not that kind of fight or flee. She said, a new Barnes & Noble is going to open a block away from me, and I have to decide whether I'm going to fight. And fighting would require me to take the rest of my savings and put it into my bookstore, which her grandfather had opened 60 years ago, into the bookstore. Flee would be, she had a very favorable lease, and she could have actually gotten out of the lease and been paid $2 million to go away. So should I fight or flee? I said, I still have no idea why you're here. She said, if I'm going to take the rest of my savings and put it into the bookstore, I need to figure out whether this is a good investment. She never used the word hurdle rate, but basically what she was asking me was, what rate of return would I need to make on those savings for it to be a good investment? Your first reaction is, how have you run the business for 60 years without a hurdle rate? And the reality is, as I said, a grandfather that started the business with a great lease, it kind of run itself. She'd never faced this big an investment decision. She said, can you help me? And I said, I guess so. She said, I can give you a book certificate, like $300. I said, okay, I love books. I'll call you tomorrow. So she left, and I, went to, at that time, whatever my data source was, I looked for book retailers. And I found 2. At that time, I think there were 3, but now it's down to 2. Sample size not enough, so I went up and down the food chain. I brought in publishers, and that did expand my sample to about 11 or 12. You think it's still only 11 or 12, but it's only a $300 book certificate. It's not like $30,000. I'm not going to work too hard for this. So that was enough, I said. Okay, let me stop now before I get carried away. I pulled up so I did exactly what I did with Disney. I pulled up the betas, I pulled up the debt, the equity. I came up with an unlevered beta for a book company. Notice I use the word book company because it includes both retailers and publishers of 0.72. And correcting for cash, I ended up with an unlevered beta for being in the book business of 0.76. I'm almost there, right? I have an unlevered beta for being in the book business. What's the last thing I need to get a beta for this private bookstore? I need a debt to equity ratio. So I remember I called her and I said, do you have a debt to equity ratio? She said, a what? Basically, if she said, I never borrow money, that would make my life really simple. Or if she said, I use a 20% debt to equity ratio, that would make, I've never got a sensible answer to this question. I've asked a private business owner, what's your debt to equity ratio? They might look up what's on their books and give me a book debt to equity. But most often they say, I have no idea what you're talking about. So I cheated. Here's what I did. I took the debt to equity ratio of the book companies in my sample and I assumed that in this business you have to have roughly that debt to equity ratio. Because I can't use a book debt to equity, it doesn't work. I use the average market debt to equity ratio of book companies of 21.41%, and I came up with a levered beta of 0.86. I can see the end here. I've got a levered beta, plugged in the risk-free rate, and she's a New York-based bookstore, used the US risk premium. I came up with a cost of equity of 7.5%. I almost called her and gave her that hurdle rate when I did remember something about betas. What kind of risk does beta measure again? The risk you cannot diversify with. Why are we so cavalier about the rest of the risk? With public companies, we assume that the rest of the risk is going to get diversified away. What did this lady start off her conversation? She's going to take the rest of her savings and put it into the bookstore. She's going to be the exact opposite of a diversified investor. She's going to have her entire wealth tied up in this private business, and that is not uncommon. If any of you have parents or relatives or you own your own private business, guess what? You don't have the luxury of being diversified and owning your private business because all of your money goes into that business. You're going to end up as the exact opposite of a diversified investor. You're going to have your wealth tied up in this business. So I have a generic question. You have a private business. I use this risk-free rate plus beta times risk premium like I have in this case to come up with the cost of equity for your company. Am I going to underestimate your cost of equity or overestimate it? I'm going to underestimate it. Why? Because all that other risk, which I'm assuming is going to get diversified away, you're exposed to. You got your entire wealth tied up in it. And when I first started thinking about cost of equity for private companies, this is the wall I would run into. I know my cost of equity is too low. What should I do now? And I still remember the first time I did a session for private company appraisers, I threw this question out to them. I said, hey, you guys use risk-free rate plus beta times risk premium. That's supposed to be for diversified companies. What do you do with private companies? You know what their answer was? We add 10%. I said, why 10%? And the answer was, here when I got here. I don't know, we all add 10%. And that doesn't work for me. I don't see why 10% is a magic number that works everywhere, so I decided to approach it slightly differently. If you go back and look at these betas, right? So I pulled these betas from Bloomberg. They're my R squareds, the last column. What does R squared measure again? The proportion of the risk in a bookstore that comes from the market, right? In fact, the average R squared or the median R squared across these companies was 26%. So here's what I'm going to do. I'm going to set up an algebra problem. If you're a diversified investor, all you care about is market risk. And I give you the beta and you're okay. If you're an undiversified investor, you're exposed to the rest of the risk. And if I can somehow bring the rest of the risk into your computation, then I'll come up with a cost of equity that's more meaningful. And I have a sense of how much that rest of the risk is from these regressions. So I took the beta that I had, 0.8558, and I divided by the square root of the R squared, which is the R. Why did you just say R? Because the R squared is what the beta regression gives you. The reason you have to do this is actually very simple. Beta is a standard deviation concept. R squared goes with variances. So the first time I wrote the book, I actually missed this. I actually divided by the R squared, and then I realized, oh my God, I shouldn't be doing that. What do I end up with? Essentially, I'm saying if 51% of the risk in a typical bookstore is market risk and your beta is 0.86, you're now exposed to 100%, not the 51%. I have to scale up your beta to capture the rest of the risk. And that scaled up beta that I get is about 1.68. Much higher than the market beta. Why? Because you're not diversified, you're exposed to the rest of the risk. I plug it in, I get a cost of equity of about 12%, which is the number that I delivered to her. And she asked me two questions. The first question was easy to answer. I gave her the answer. The second question I knew the answer to, but I could not think of a kind way of giving the answer. The first question she asked was, Barnes & Noble, publicly traded book retailer down the street, what's their cost of equity? What's the answer to that? They're publicly traded. Their investors can diversify away firm-specific risk. They're going to be using the 7.5% cost of equity, right? I said their cost of equity is 7.5%. And she asked me the second question. She said, if my cost of equity is 12% and their cost of equity is 7.5%, how the heck am I going to compete with these guys in the long term? And what's the honest answer to that question? You cannot. In business after business, Public companies are going to drive out private businesses, not because private business owners don't work hard. They actually work harder than the public company managers might. But it's incredibly inefficient to take all your wealth and put into one investment, right? Which is what you do with a private business. It gives you a mountain to climb every time to get to the same point that public companies are. And I'll give you a couple of examples that have been transformed by this, and this is going to happen across businesses. 25 years ago, if you walked into a pharmacy in the US, the owner of the pharmacy was usually behind the counter. Most pharmacies in the US were owned, privately owned, pharmacists behind the counter. Today you walk into a pharmacy, you look up, what do you see? You see CVS, Duane Reade, publicly traded. There are a few private companies that hang in there. Either because they managed to diversify across businesses. That's how the old family businesses in Asia and Latin America dealt with this. Is you look at the old family business, you ask, what business are you in? They're in every conceivable business, because that's how they dealt with this. Because as you get diversified across businesses, your R squared with the market rises, the disadvantage goes down. Or they hold on because they value being a private business so much, controlled so much that they're willing to give up value. I'll close with an example. You know how, this you might have already done that, they auction off stuff and you guys bid for it for, I don't know what it goes for. And every year the only thing I can give to the auction is, I'll do a valuation. And usually, people bid for it. Most of them don't even take advantage of it. I don't know why, they just pay the money, I guess. But about 3 years ago, somebody in the class wins the auction. It's about $1,500. They said, company to value. So what, small company, and he comes in with these big stack of documents. And so, what's your company? He says, we make rum. So where are you from? Said, Miami. I knew where this was going. And I said, is this company Bacardi by any chance? He said, yes. So what have I gotten myself into? Bacardi is a private company, privately owned company. And you could argue that perhaps as owners, you're giving up a lot by keeping it. And every generation, the tension will get worse, right? The reason it's going to, and because that's the nature of your private business, you are leaving value on the table, and that pressure to kind of unlock that value will push you towards a public space sooner or later. So we'll start with a quiz on Monday, and after that, we're going to start talking about cost of debt and cost of capital. We'll complete the process of discount rates. Right? On the hurdle, they'll have lower hurdle.
Right. My question is, would you say the same these days? Would you say that public traded companies are, in general, especially in the tech industry, are they going to be outcompete?
Well, private. Give me an example of a private tech company.
For example, I think Uber.
Uber is not really private, right? It's public. It's really a public company in the private space. If you look at its investors, its fidelity state, these are the same people. The only difference between Uber as a private company and a public company is disclosure requirements.
Right.
So they're already, so most tech companies, which are viewed as private companies, are really either private companies waiting to go public, which was true for Snap for the last 2 years, or private companies are already really public companies in terms of capital action. The Saudi Sovereign Fund invests in Uber. That's not what a private company does, right? So they have all the advantages of a public company in terms of access to capital. And they have the advantage of not having to disclose stuff or not having to do everything in the end. So tech companies often are almost never run as private companies. The private companies I'm talking about are your local grocery store or your small or a small plumbing business that you run. Those are the businesses that you see the pressure building on, because 20 years ago, 30 years ago, you're only small plumbing business. Now you're plumbing companies that now come, they have numbers, they can stretch across towns. They come to you and say, I will pay you $150,000 to sell your client list and become my employee. Initially, you're going to fight it, right? Because you want to be your own boss. This is your business. You built it up. But then, let's say you're 71 and your son is looking at this business and he's saying, Dad, I don't want to be a plumber for the rest of my life. I'd like to collect the money. So it's usually at the generational shift that you see the breakdown because of the emotional connection breakdown.
So I guess the key is for private companies right now, there's a blurred line between, they have easier access
In
to
the tech
capital.
space, that's always been true. The tech space, the line, no tech company was ever run as a private company with the intent of staying private. It was either to sell to a public company or go public. Because the disadvantage of being a privately owned tech company is immense, right? There's so much risk you're now bearing that you're not going to get rewarded for. So many tech companies, even the private, are public companies in waiting. Okay? It's really in the other sectors where you have big private, like Bacardi. We've got to ask, well, what keeps them private? And there the answer has to be the family values control enough that they're worth $1.5 billion instead of $4 billion. Big deal. They're all really rich people who now control the entire company. But there again, the tension builds up with each generation. Is each generation, the new generation says, you know what, we'd like to cash out. We'd like to be worth $50 million in cash rather than
It's
$50
like
million.
owning a piece of land.
Oh, exactly, right? I own a piece of Bacardi. It doesn't help me if I will go into a store and I try to buy something, I can't pay with a piece of Bacardi. That's I'd like to cash out. And that's the pressure that builds up, which